Hello, everyone, and welcome to Currency Exchange, a NatWest podcast all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10 FX strategy at NatWest. I'll be your host today. And once again, I'm happy to be joined by Paul Robson, who co-heads G10 FX strategy with me over in London to talk about all things FX markets. A big week of data in the UK, certainly a lot of geopolitical tensions right now, and thinking about how those translate in some ways and in some ways don't translate into moves in FX markets. So, Paul, thanks so much for joining.
Well, thanks as ever for the invitation. Like you say, there's a nice mix of individual focus on countries, macroeconomic data, but also some of these geopolitical events. From my point of view, I think it's interesting to put those into context about the key themes we thought would be playing out through 2026, because some are tracking, some are not tracking as well, but the prospects for them to retrack. I guess that's one way of looking at it. So lots to talk about. Looking forward to it.
Yeah, so let's start. I do want to start in the UK because one of the things that we've been talking quite a bit about is how this week in particular was such a big data week. Can you run through why this was such an important week for data and what we saw from some of the really key data in the UK this week?
Yeah, the reason it was an important week is that we had the two big monthly releases, both in terms of the labour market, but inflation. And both those releases are very much a focus for the Bank of England's Monetary Policy Committee. Inflation in the UK has been relatively, well, it has been suddenly high since the energy price shock. And obviously, we had some global themes in terms of inflation. And I think policymakers are wondering whether we've had a structural shift in price and wage formation, or whether it's just taken a little bit longer than usual for some of these shocks to inflation to work their way through. And in fact, ultimately, they won't have a persistent impact. They'll just have a temporary impact, but the temporary impact is shown to be longer. So, and also for the labour market data as well, the MPC at the last meeting, they noted a deterioration in the jobs market, and they also were falling back a little bit on their agent reports around the country that suggested maybe the labour market was deteriorating more quickly than the official data would suggest. As regular listeners will recall, so not a secret, there are some doubts about the quality of some of the UK's labour market data. So it's only right, I guess, for the MPC to use the agent's report and some of the survey data as well at this important time. And then inflation numbers are always important to what, the drivers of inflation, which bits are easing. But there were actually a couple of strange market reactions. We think that the dovish reaction of the markets was too great. In terms of the labour market report, there seemed to be a big focus on headline average earnings growth, which was unexpectedly weak, just above 4%, 4.2% on an annualized basis, compared to 4.6 that was expected by the street and our economics team. So that was a meaningful decline. It's still very high when you think that productivity in the UK is relatively low. It's still consistent with high inflation. The reason it was a surprise to us is that big undershoot in wage growth was actually driven by bonuses, and bonuses can be very volatile year to year, and the timing is very important. It does feel that when those bonus numbers even out a little bit, headline inflation will go, headline average earnings growth will rise again. And when we strip out the impact of bonuses, the numbers were actually in line with expectations. So we're surprised that markets became more confident that the Bank of England will cut rates in March relative to April. And they also priced in more easing through the year and a lower terminal rate. And we're also surprised given that some of the employment numbers in the report were actually a little bit stronger than expected. Again, these numbers can be quite volatile, and we tend to focus on the payroll numbers, very much like you do, Brian, in the States. And the numbers for the latest month were better than expected. And also the fall that was recorded quite a sizable fall the previous month was actually revised away almost to flat. So if you get that core average earnings growth in line with expectations, employment doing relatively well, we're surprised that there was such a big reaction. And the third point was that markets seem to focus on the unemployment rate in the UK that was slightly higher than expected, and to be fair, drifting higher in recent months. But for the unemployment rate, it is based on the labour force survey. And this is the part of the numbers that markets have less confidence in. So that's important. In terms of inflation, inflation was relatively resilient. And I would just draw people's attention to the 4.4% annualized rise in service sector inflation. That's a proxy, really, for domestically driven generated inflation. And again, if you've got inflation in the service sector at close on 4.5%, given productivity is relatively weak, we just think that price pressures remain pretty resilient here in the UK.
So I think you touched on a lot of where I was going to go next, which was to the Bank of England, because I think back to just a few weeks ago with Governor Bailey saying the market at a 50-50 odds for a March cut was a pretty good place to be. After the data, as you mentioned, there was a big move in the more dovish direction. You went through, I think, a lot of the good reasons why maybe to be skeptical there. So what are you thinking here about Bank of England more broadly, and how are you incorporating that into your thoughts on sterling here?
Yeah, so in terms of the Bank of England policy rate, we think that there's one final quarter point rate cut coming from the Bank of England, potentially at the April meeting. The Bank of England, we think, needs more evidence that inflation's coming down, and importantly, that that's impacting wage formation. And we're not sure that they'll get that information by the March meeting. But as I said earlier, the market seem more confident that that rate cut comes. Unlike the market, we think that the Bank of England will be done after that rate, that quarter point cut. Markets seem a little bit more confident that we get down to 3.25% for terminal, and maybe looking to it to be a little bit lower than that. But so we think markets are too dovishly priced. How that plays into the currency, we think, is more about if markets ultimately adjust their terminal rate expectations closer to our own baseline, that will support sterling modestly. It does feel like sterling is being driven by two things at the moment. One is politics, and the other one is relative yield. As, for example, as the ECB doesn't cut rates, the Bank of England cuts rates, the interest rate differential is narrowing. That's been a loose correlation, and I think that matters. The second one is the political risk premium, which I think is sort of ebbed a little bit. The political risk sort of rose a couple of weeks ago, and they've eased back almost as quickly as they rose. And we think, although there's risks around the by-election at the end of February and the May local elections, that's a little bit too far in the future at the moment. And the other driver for sterling, we think, is that the currency quite often is a fair weather currency. If risk markets are doing relatively well, equity markets are moving higher, then sterling tends to do a little bit better in that environment because it has a slightly higher yield. And markets seem a little bit more worried about geopolitical concerns at the moment, and that's weighed on the currency. So we're pretty neutral on sterling euro, for example, but we do think sterling dollar still rises through the year. As we've talked about lots of times, haven't we, Brian, on this call, it's more of a dollar view rather than a sterling. So a sterling view, pretty neutral at this point.
Yeah, certainly as an external observer from the US thinking about UK politics, it certainly feels like, to the point you made, that the sort of acute risk around UK politics maybe has come down as a driver of sterling recently, exactly the point you just made. But as you mentioned, those risks I feel like are still there. Can you just talk a little bit more about some of the event risk you talked about in terms of why we're paying attention to UK politics as a potential driver of sterling here? Maybe not as serious as an immediate term risk as maybe it was a week or two ago.
Yeah, I think there's a couple of ways to look at it. Obviously, leadership change just brings uncertainty and a higher risk premium associated to the currency. But for the UK, I think the main worry is this idea that you get a dilution of fiscal policy, maybe the fiscal rules, if we do get a change of leadership. Certainly that's the correlation that has been quite clear through the last sort of year, especially, that if we get a change, then and maybe borrowing goes up, maybe spending goes up, or tax increases come through. And if you get tax increases, then the Bank of England ultimately cuts rates a little bit more quickly, reducing the carry on the currency. It will be interesting to see. There are a couple of events, like I say, the by-election, the local elections, that could be a lightning rod for volatility in the currency around that. And you got a little bit of a citer on this week, actually. It didn't get a huge amounts of report, but there's this idea that the government potentially has to quicken the rise in defence spending, and while you can change the fiscal rules to accommodate that, ultimately spending is spending, and it has to either be paid for by higher taxes or borrowing. And the unfortunate sort of position the UK finds itself in is that the stock of debt's already quite high, funding costs are quite high, the deficit's quite high, and it is the same in lots of other developed economies. And so there will be this competition for the supply of government securities, a buyer's market. And I think that's where the risks are. And people see the currency as, at one level, a simple release valve for all the worries around the UK, which I think matters. And then equally, sometimes it plays through via the Bank of England policy outlook.
I think that's a good point to bring up, just that, at the end of the day, more spending is more spending, and the market's expectations around fiscal policy do matter in currencies. And it's funny that we talk about those risks in the UK, where in Japan, we're sort of thinking about it kind of from a different angle, which is Takaichi, after her dominant win in lower house elections, the LDP's dominant win, has really been saying all the things that the market wants to hear in terms of being more pragmatic. I'm talking about cutting consumption taxes, but finding alternate ways to pay for that spending rather than increased deficit financing. The proof is always in the pudding when it comes to politicians making pledges around how much spending they will and won't do. Ultimately, the market, I think, is still going to have to deal with that risk as we get more details on that plan. But it's interesting to hear, sort of the dichotomy there, where Japan, a lot of the big drivers of yen have come back to expectations around fiscal policy and potential for fiscal expansion. I guess similar themes, but obviously very different implementation. And more recently, the market seeming willing to take Takaichi at her word that maybe she'll be moving in a more pragmatic, market-friendly way in terms of trying to finance some of those fiscal priorities. I do want to take a step back here before we move to geopolitics and talk a little bit about the tension between US and Iran, and just think about carry in general, because I feel like that's been a big point of focus, certainly in our writing, as we think about like what are the sort of frameworks that drive the year ahead. I mean, you just look through the league table of currency performance year to date, and you just see a lot of the very high carry currencies kind of towards the top. How are you thinking about carry here in general, and how that's informing on your outlook for global currencies?
In one respect, I think it's that macro volatility remains relatively low, and we discuss quite often, don't we, about carry to vol relationships that carry or higher yielding currencies are favoured when markets are relatively becalmed, although you have those geopolitical risks, which I'll be really interested to hear what your latest thinking there. They haven't quite had the market impact that perhaps we would have expected in the past. And as you say, it feels like carry is important. And it was one of our top 6 themes for the year, as you mentioned. Actually, it was number one in the list that I normally run through. And I think you have had more divergence in monetary policy outlook across the major economies, and more in a hawkish way. It's not like rates are coming down more quickly. We're sort of speculating, aren't we, about whether the Fed cuts aggressively or doesn't, because of resilience of the data in the US. Australia, RBA, have signaled they've raised rates in an easing cycle, which is a little bit of a contradiction, but that reflects the macro fundamentals. And I wonder whether markets go looking for the next carry currency after the Australian dollar, and that's supported by the RBA. And the one that I think jumps out is the Norwegian kroner, where they haven't really started their easing cycle, and inflation has been stubbornly high. Now, we think that the oil price is normally the key driver of Norwegian kroner. So we were fairly neutral at the beginning of the year in terms of the Norwegian kroner. But given the policy outlook, I think that maybe it becomes more attractive. And so whether it's attractive against the Canadian dollar, for example, or the Swedish krona, which has a lower interest rate and has performed really quite well. So I think carry is going to remain a theme as long as macro volatility remains.
And I think as we think about carry, where does the dollar fit into all this? Because, one of the things we had this week was the FOMC minutes, and not really a ton of brand new information in the minutes. But what you see is just a massive differentiation among individuals at the Fed about where policy should be going. We had several members thinking that additional cuts were probably going to be warranted, and several others apparently wanted to change the Fed's guidance to make it clear that they were effectively at a pause and tried to open the door to the next move being a hike rather than a cut. So very similar in the US, where we have this dichotomy where we have some arguing very strongly for cuts, others arguing that we're probably in a place to be on hold for the foreseeable future. And with the massive elephant in the room being the change in the guard at the top of the Fed, the new Fed chair coming in and potentially skewing that balance in a much more dovish direction. And like you said, Paul, I think one of the issues the dollar has run into this year is that the market, I think, has really struggled to translate strong data, firm data at the beginning of the year into a more hawkish Fed outlook, because there's new leadership coming into the Fed who see this strong data as not necessarily strong enough to boost inflation pressure because of productivity-led gains, for example, and how investment rather than wages and the labor market is really the driving force behind stronger growth. So in this carry environment, the U.S. currently has, still has high rates, but is expected to be cutting perhaps aggressively, while a lot of other economies in the world are either at or close to their steady state here. So I think a really important driver here, and the U.S. is kind of in a unique position here as well. So maybe now's a good moment to turn back to geopolitics, because certainly tensions between the U.S. and Iran are front and center. And while we could speculate all day whether that translates into concrete military action by the U.S. or not, maybe it's more useful just to think about currency responses in an environment of higher oil prices, because regardless of what actually happens on the ground, we have seen oil prices rise to their highest level of 2026. Oil prices are still low in global macro terms. And I think that's appropriate because oil markets are still suffering from a supply glut. Oil supply growth has been pretty strong, thanks in part to rising supplies throughout a lot of the Americas, think Guyana, Brazil, United States. And OPEC supply quota increases throughout 2025 added to that sense of increased supply. Demand growth is seen as slower than supply growth, which leads to this overabundance of supply, at least in 2026. Although I think you could argue that stronger growth at the start of 2026, certainly firmer data in the US, some maybe less downturn in growth than feared thanks to global tariff rollout. Maybe the demand picture is arguably firmer now than we believed it might have been 6 months ago, but still in a period where supply of oil appears to be overhanging demand growth. And so that implies net inventory build in oil going forward, coming out of years of the inverse in the post-pandemic period, that you now have this period where it looks like supply growth is going to outpace demand growth. And so the fundamental picture for oil, I think, is still to the downside when you consider adding in the possibility that we lose oil supplies from Iran, either directly via reduced capacity of the country to export oil, or indirectly via the Strait of Hormuz, which is a critical oil conduit through which a lot of Middle Eastern oil finds its way into global markets. In terms of Iran, because of US sanctions, it's widely believed that China and India are the primary or maybe only major buyers of Iranian oil. So it's not to say that Europe, for example, will lose supplies of oil if Iran is unable to continue to ship oil in the way that it has, or that the US would lose oil supplies. But of course, if you remove barrels from the global supply picture, then that's going to have an impact on prices. temporary changes in demand are generally seen as look through, although they certainly have impact on oil prices. You mentioned Norway already as one of the potential beneficiaries here. There's already a pretty positive policy picture, and higher oil prices appears to have also been fueling some of maybe that outperformance in Norwegian krona. Canadian dollar has been maybe it's struggled a little bit more. I think part of that has been that the global dollar has weakened, even though that Canada itself is an oil producer. Another one to watch are the oil importers, and Japan is really the one that jumps off the page here because, with a weak currency and imported price pressures already pretty high, higher dollar denominated oil prices with a currency that's still weak is not a good mix for your import basket. And so is the Bank of Japan in position to respond to higher inflation due to factors that are really outside of their control, say, for example, higher oil prices? It's hard to say. But if we think about how rising oil prices impact sort of the G10 landscape, I think we are generally looking at, number one, oil prices have risen, but they're still low in sort of terms. I wouldn't say low, but they're not high by historical terms. Second would be if we do see higher oil prices, the fundamental picture probably doesn't necessarily argue for them to stay high without some major change in sort of permanent change in Iranian oil supply. And then the final point would be that importers of oil, those that rely heavily on imported energy, are probably more at risk here from a macro side, whereas those that produce energy and supply energy to the world may be better positioned. So those are all of the sort of macro factors we're trying to track here as we consider the geopolitical situation, and that as the situation in Iran and the US evolves, those are the macro factors through which we're going to be the lenses through which we're going to be trying to view FX market. So I think we've covered a ton of ground here today, Paul. Thanks so much for joining, and thanks for the conversation as always. And to our listeners, thanks so much for listening. If you enjoyed the podcast today, please consider giving it a like and also subscribing to the channel so that you can get our content the moment it's released. Thanks so much.